My dad sent me this morning. He said you were always destined for greatness or something like that.
You are.
Look at this.
In that shirt, you always are.
That's actually great. That's actually pretty. That's not bad. It's
So-
not a bad picture.
You should bring that back if you're able to.
Yeah, I wish.
Or I'm gonna get you a wig.
I wish. No, the ship
I
sailed.
mean, I can just use before or after. When do you want this?
Right now.
You want it now?
Yeah.
One's for
Is it
Josh.
one for Josh?
Yeah.
Ooh, a physical book.
I
So,
like giving them books.
I finally gave up on this idea that I would ever read again. Like not ever, but like right now.
if not, make Matt and Sean read.
I went to audiobooks.
Did you? So
did.
I do a combination of audio or like I have stuff on my Kindle because I feel like it's like I always have my Kindle with me. So if I'm feeling like I want to read something that's really meaty, like I at least have I don't have to remember a physical book with me.
I'm a Kindle person.
I switched to the Kindle about a year and a half ago because I was finding that I was trying to read at different times, and even with like my husband would be sleeping and I want to read and I'm like annoyed. So I was like, so you
Oh
need
shit. Sorry.
If you want it, I won't be offended if you need to return it. I'll give you the receipt. If you need the
It's a great looking
auto
cover.
book. The cover's worth it.
Yeah, I'd buy this
Yeah.
book for the cover. Thank you, Todd.
Hey, my pleasure.
Did Mike Tyson? Oh, wait, Mike didn't sign it?
I tried.
you.
He wasn't
Thank
at the
you.
Barnes and Noble
Thank you.
doing a signing.
Was there a period of time, in fact, there probably was, where Mike Tyson was one of the top 10 most famous people in the world?
Oh,
Maybe
yeah.
top 5?
Yeah, especially around the time when he was married to Robin Givens, and I think they had that I don't know in the world, but certainly in the U.S.
Hulk Hogan. We were just talking about this.
Pour one
One
out.
of the most. So
He
there's
was
people
easily-
that are globally famous, where everybody in the world, in every country, doesn't matter where you are, knew Hulk Hogan.
Tyson and Hogan, definitely.
And there's probably over the last 50 years, there's probably 20 people on the list that were the most famous people in the world. It's not a long list.
Jordan, Tyson,
Ali. There's not
Hogan, Ali, yeah.
Tiger Woods. There's not a big,
then,
big
Couple of
Mother Teresa,
the presidents.
Taylor Swift,
Taylor Swift. It's not a long list. So,
the Beatles,
the Beatles.
but only 2 of the 4 Beatles.
The Hulkster.
You know,
Pour one out. We could have went to SummerSlam, by the way.
Where's it was at the Garden.
It was at MetLife.
I've never been to a wrestling event.
Oh, should we go? We'll bring Shannon.
I think that ship sailed.
I have not been to a wrestling event either. Interesting.
Have you?
It's been 20 years.
Yeah.
It's been a long time. They're fun. Why not?
Are you a PPI gal? Do you care about producer prices?
Yeah.
Yeah.
I definitely do, especially when it's all services like it was today.
So I was thinking about that. What are services within producer prices? That sounds weird.
Yeah, it's inputs into what ends up being some of the stuff that came through in CPI, like motor vehicle and that sort of stuff. So service, the kind of the goods to produce service that are going to go into services delivery.
I saw the big one was fruits and vegetables or dry vegetables was up 38%. What are dry
But the
vegetables?
food stuff is it moves around a lot. You shouldn't put a lot of emphasis on anything food related.
Well, the market doesn't seem super bothered.
Well, it did at first,
For a
and then
second.
it decided. But I don't know why they were expecting 50. I mean, that seemed like such a pipe dream.
What do you mean expecting? Oh, rate cut?
For a rate cut, that seemed completely unnecessary.
S&P's down 7 basis points. Equal weight's down 70. Man, it's nothing.
That's the
It's nothing.
defensives, mega caps.
Nothing.
Where's the big guy? Vacation?
Josh is moving his daughter back into
back
college.
to Miami.
Yeah.
Right.
How old are your kids?
6.5 and 3.
Okay.
We
yeah,
got
we
a
have
ways
ways to go.
We got a ways to go.
You guys got some time.
All right, Shannon, you ready? Ready to pod? Oh.
Can I do my Josh impression? Welcome to the compound and
go.
friends, ladies and gentlemen.
All right,
Hold
time
on.
to up the energy. I'm feeling low energy, people, and it's starting from this side of the table, so it's time to turn it up. Let's go.
We're turning it up.
Thank you, Nicole.
The Compound and Friends, episode 204.
Today's show is brought to you by Grayscale. Curious about investing in crypto and not sure where to start? Start with Grayscale. Grayscale is the world's largest crypto-focused investment platform and has been in crypto since 2013. That's a long time when you consider how early we still are in crypto adoption. Grayscale also offers the widest selection of crypto investment products in the U.S. Over 30 different funds for investors to choose from. That's plenty of choice for both first-time crypto investors or crypto experts. You may not be considering crypto for your portfolio today, but whenever you're ready, Grayscale can be your guide. Grayscale, invest in your share of the future. Investing involves risk, including loss of principal. For more information, visit grayscale.com. Here we go. When do we start talking? When do we wait for the music? Let's go. All right. Excited. Shannon, it's been too long.
It has been too long.
March of 23?
I think I was on in like January of 23.
Okay.
Because I was on before.
Been too long. Welcome back. And Todd, have you been on too much? Are we like overexposing Todd Sohn?
You might be overexposing me.
Might be too much. All right, this is it for you.
apologize.
We'll see you in 2027.
I want the next Olympics.
Okay. All right, welcome back to the Compound and Friends. My name is Michael Batnick, and I am excited to have my friends back with me. Shannon Saccocia is the Managing Director and CIO of Wealth for Neuberger Berman. Prior to Neuberger Berman, that's okay. We won't go there. We know.
It's always up for discussion.
Yeah, she's been on Wall Street for a while. All right, and Todd, of course, is an ETF and technical strategist at Strategas Securities and Strategas Asset Management, an institutional research and asset management platform. Prior to Strategas, Todd has had several roles at both JP Morgan and SIC Capital Advisors. All right, so it seems to be that one of the narratives around the market, and there's like a lot of different narratives, but one of the ones that keeps popping up is what's happening? Like, why is the stock market up? Does anybody know why the stock market is up? There was an article in the Atlantic this week, and this was the headline. Does the stock market know something we don't? And this is one of the paragraphs. As the stock market soars ever higher, the theories of why it rises have suffered the opposite fate. One by one, every favored explanation of what could be going on has been undermined by world events. The uncomfortable fact about the historic stock market run is that no one really knows why it's happening or what could bring it to an end. Well, that part is true. Nobody knows what could bring it to an end. But I was thinking about this, like just taking a step back, zooming out, as they say, why is the stock market up? And even though it feels like things are funky out there in the world, certainly there is some shenanigans going on that you don't like to see, but I don't think it's that complicated if we zoom out. All right, you guys ready to zoom with me?
Definitely.
Let's zoom.
All right, there's three reasons. Number one, most of the tariff uncertainty is behind us. The VIX explosion that we saw in the spring, Liberation Day, like it's not great, but it is, right? At least we have like a better understanding of the range is not as wide as we previously thought. That's 1A. And 1B would be earnings. Now, whichever way you slice that, if you're looking about actual earnings, which is what drives this market, if you're looking about earnings expectations for the future, which is also what drives the market, and then most recently, the gap between estimated earnings, John, chart on please, and what we saw in the first quarter. So we've got a gap that is as wide as we've had for the last 10 years in terms of what the analysts were expecting and what the market delivered. Okay, so that's the earnings part of it. Then we've got rate cuts are coming, right? The president is not too fond of the current head of the Federal Reserve. When he's out, there will be somebody else. Rates will be lowered. And then number three, and maybe today threw a monkey wrench in the PPI, but inflation is generally all right. And so if you had those three things, earnings, and Shannon's ready to jump out of her skin, earnings at all-time highs, inflation sort of on the right track, and rate cuts coming, why would you expect the stock market to be? Oh, I haven't even mentioned the tailwind of the hyperscalers and AI, the AI bubble. Where would you expect the stock market to be? So Shannon, please.
Well, I want to start with the tariff point, because I do think that we don't have any further clarity, or we have minimal clarity in terms of what the end game in terms of tariffs is. What I think we understand is that the implementation of that is going to be inelegant or, inconsistent at best. And so I think if you were looking at all of the numbers, everyone's re-ratings in terms of GDP and inflation coming out of April 2nd, between April 2nd and the end of April, everyone was anticipating that whatever that top rate of tariffs would be across the board, that there would be very few exceptions to those tariffs. But more importantly, that companies would be unable to actually deal with and digest those tariffs. And that's the thing that I think, and I think this actually bleeds into some of the earnings conversation. If you think about what management teams have had to grapple with over the course of the last 10 years, coming out of the GFC, very low growth rate environment, sovereign debt crisis in Europe. And then you get to the point where, we had tariffs that came on in 2019 following what should have been, a pretty stimulative tax legislation. And then COVID. Management teams have figured out how to protect their margins and grow their earnings against a hugely difficult backdrop. So I think that there was part of that we didn't get the same type of direct implementation and transmission that perhaps we were factoring in as that worst case scenario. But we also, I think, very much understated companies' ability to figure out how to pass on some of these tariffs or shift things on the fly we're essentially helping to soften the blow. Now, will we continue to see that? I think so. But I think the important piece of this is that I just think that we were underappreciating corporate America's ability to figure stuff out.
Chart 6, please, Daniel. So I remember this line stuck with me. Savita said, I think this was during 2022, never underestimate corporate America's ability to protect their margins. They are really, really good at that. And once again, we underestimated them because this chart from Goldman shows the frequency of S&P 500 earnings surprises. So what the analysts were expecting and what companies actually delivered. And this was by far the highest in terms of one standard deviation above consensus estimates. The gap was huge, as big as what we saw during the COVID years where we're like, what's happening now? It's that much of a surprise. So again, and I didn't even mention deregulation and the Wild West nature of the IPO market opening. It's all happening. Where would you expect the stock market to be trading?
It's higher to me. Listen, I think this was largely a sentiment rebound too, right? So Shannon eloquently put everything on the fundamental backdrop. And then in our work, he came into the year with the super aggressive sentiment backdrop, right? That happens after back-to-back 25% years. Tariffs blew that up. And the recovery has been remarkable since from the technical landscape too, breadth and momentum. And even today, the sentiment data is not uber aggressive. That's the sense I get, at least from the survey data. Some of the quantitative data like options and VIX maybe skew a little bit complacent, but that's okay for now.
I think one of the things that's confusing market prognosticators or pundits is there's a lot of different market participants. Yeah. And we've been talking about this a lot.
What do you mean by that word?
I'll tell you. Oh, pundits?
No, I meant market participants, but pundits will speak too.
So here's what I mean. If you look at retail traders, if you look at people that are speculating and they're having a great time and they're making a lot of money and there's a lot of silliness, you would say euphoria, right?
Yeah.
Absolutely, you would say euphoria. This was a tweet yesterday that was just a 10 out of 10. Mike Bird, the Wall Street Journal tweeted, shares of cryptocurrency exchange bullish, soared more than 150% in its initial public offering Wednesday, highlighting the challenge of pricing an IPO in today's exuberant market. To which Mike quote tweeted and said, and Mike's a journalist, he said, I'm not saying this is the top, but if you were writing a novel about financial exuberance and you invented a company called Bullish IPOing and rising 150% on day one, your editor would take it out as an unnecessarily theatrical flourish.
Yep.
Don't gild the lily, I believe is his phrase in literary parlance. So you have that part of the market, right? Which is obviously balls to the wall, everything goes, whatever. Crypto, the treasuries, ARK, which we'll talk about later. So you have that cohort of investors. However, you also have older investors who are very confused, who don't seem to understand why the market is rallying. And I do think the sentiment is a huge reason why.
Yeah.
But Schwab publishes their quantitative report on their investors. And Schwab is the largest or the second largest platform in the entire galaxy. And their investors, for 6 months in a row, have been dumping technology stocks. NVIDIA has been the number one net seller up until July. They finally bought. Apple was the largest last month. They're not aggressively buying it. They have a sentiment measure themselves, which is quantitative. It's not, there's nothing squishy about it. And it is nowhere near where it was in 2021. So which investors are we talking about? It's really hard to gauge. I mean, like everyone's bullish? I don't think so.
I've had this struggle of what is retail today. I feel like years, decades ago, maybe it was a certain type of person. Now it feels like it's 10 different things. Does that make sense? And
it does.
I'm trying to figure out how to parse that data, and I haven't quite figured it out yet.
I mean, you speak to investors all day, and advisors, are they feeling exuberant?
No, but so I think two things have changed. And I don't disagree with your point in terms of what does retail mean? Because I think if we go back a couple of years, we talked about the birth of, the rebirth of the retail investor. And that was really, gamification of our industry. How much are we spending too much time online trading stocks versus being out in the world during COVID? I think actually what's happened is that there just has developed into sort of three buckets, which is it used to be just retail and institutional. And now what I think is institutional is there are portions of institutional that aren't big pools of capital that are run by pensions, that are run by schools, that are sovereign wealth funds. I actually think institutional is that increasingly advisors such as us, I'm pointing to you because you guys are in the same boat as I am, we've developed institutional frameworks and mindset that we're applying to the challenges for what have been traditionally retail investors. And what that implies is that there's been created some additional guidance around making good decisions. The thing that you're actually not hitting on, though, is that what I think has changed a lot in the last 2 years is basically if you look at a portfolio and people are feeling like I want to invest in something that I feel can continue to grow their earnings, you can be in a position where I feel like a lot more sure about corporate balance sheets than I do about the U.S. Treasury right now. I think that people are feeling more comfortable investing in equities because they believe that there is there's the potential for those companies to continue to be much more disciplined than the U.S. government. And so I think it's actually what we're seeing is that we're seeing investors increasingly comfortable with maintaining larger equity allocations over time because they feel uncomfortable with the lack of discipline in things like Washington, in the federal government. They feel more comfortable with corporate balance sheets and corporate management than they do with what's happening in Washington today. And so I do think that what you're getting this creep of higher equity allocations that I think is going to continue to support buying in the equity market.
The Journal just wrote a piece today highlighting exactly that. At every age cohort, from the youngins to the Xers to the boomers, everybody's allocation to equities within 401k is at an all-time high. And why wouldn't it be? Why shouldn't it be?
There's also longer time horizons. I mean, we're not going to live less, we're not going to live fewer years than our parents did. And that's going to continue with our kids and our grandkids, right? And so just that the longevity of that, the time horizon has been pushed out. And so you're going to hold equities for longer and you're probably going to hold equities, more of them. So despite these periods where we see this pressure, why wouldn't I continue to buy if I'm in my early 60s and late 60s and early 70s? I have 30 more years.
Are you seeing anything in flows that support that or dispute it or?
No, not dispute. Equity ETFs do $2 to $3 billion a day now.
Equity what?
Equity ETFs. Just in general, large cap equity ETFs do $2 to $3 billion. ETFs in general are going to hit $1 trillion in inflows, right? There's no stopping that. I get more interested when I start to see certain categories get kind of hot. And the only one that really screams like maybe put the brakes on is crypto. But the other side of that, the thing with crypto is it mass enthusiasm or is it mass adoption?
The thing that's weird about crypto to me, and that I think pisses people off, is like, still nobody owns it. Which is, it's this weird thing where the price is going parabolic, and certainly any rational person would say like, all right, maybe like it's time to pump the brakes on going all in on crypto if you've never owned it. But who owns crypto? It is still largely owned by the early adopters, and you're just starting to see institutional adoption in a real way. Harvard revealed. What was their investment?
It was a silly amount. Not silly is a bad idea, but like it was a chunky.
Was it 150 million?
Yeah,
it was
definitely a one something.
But I would say that investors in general, like air quote, nobody owns crypto. I know it's not actually true, but it's very under-adopted.
I think the challenge too is that if you have been an early adopter in crypto or digital assets or whatever moniker you want to apply, right, to what we're talking about here, you now are pointing at those ETFs as being a really inelegant way to access the enthusiasm and opportunity in that. And so what you're getting is this this kind of barbell of, people who have been in the community, in the industry, investing for a long time, and they've already moved on to other ways to potentially invest in that. They're looking at tokenization, for instance, as being like the next way that this is going to continue to grow kind of digital assets as a true asset to be included in your portfolio. And so what you're getting is this, and you're also, it's compared and contrasted with, from an advisor perspective, the vol on crypto still, it continues to be really high. So how do you factor that into a traditional portfolio construction asset allocation? Well, you have to put the risk really high. And so you end up with a small position in the portfolio. And so even if you get the type of gains that we've experienced over the last couple of years, is that really going to make a difference? And do you want to have that conversation every time you meet with your client?
Right.
And I think that that's the challenge is we've moved from a period where I think advisors were very hesitant about this going to zero to, is this something I really want to have a conversation about every quarter? And I still think that they are feeling like at the sizes that these positions would be in, probably not going to move the needle. And they'd like to spend more of their time in that conversation on other parts of the allocation.
So it sounds like your advisors and their clients are not like banging down their door for crypto. Because over here they're not. And like my friends aren't asking me about it. It seems to be like most people, even at all-time highs, don't really care.
I think what we hear, and I'm curious to hear if this is what you hear, for those that are in that former category of people who've been immersed in the community and have a meaningful slug of some sort of digital asset exposure, they would like us to incorporate that and be thoughtful about that in their allocation. But no, it's not something, and it's actually less than I've experienced during other periods where Bitcoin has gone up a lot. I'm hearing less interest now than I did in those previous
100%.
periods.
I agree. That's an interesting observation. I agree with that.
Yeah.
I haven't thought about it that way.
But I don't know if you see that in the flows too, because it does feel like we should see, honestly, like more speculation, more flows into the asset class. I mean, especially around Ether and the moves there.
The flows are definitely hot, but the conversations are far less, which is just strange. You'd think it would be hand in hand.
Mm-hmm.
Whereas 2021, let's call it, you didn't have access to Bitcoin spot ETFs, but everyone wanted to talk about it.
All right, moving back inside the market, because I could sort of feel people saying, all right, enough with crypto already. Nobody cares.
We just said that, and yet we allocated how many minutes to it.
I'll take the blame on that one. I kind of swerved there.
All right, so inside the market, I think that by definition, you're never going to have, especially never again with retail participation, and I think that people get distracted by this a lot. There will never be another bull market where you don't see insane behavior. Would you agree with that?
As in you'll always see insane behavior?
Yes.
Yeah. Oh, yeah.
Like irrational exuberance.
Yes. You will always see pockets of things that make you say, oh, this is the top.
That's the information age, right? We're in a 24/7 news cycle. And then I can go reflect that with basically any sort of exchange traded product now with leverage.
I'm wearing a Dan Ives shirt, for God's sake. All right, but I think that a lot of the silliness, and I love the shirt, shout out to Dan, a lot of the silliness is a distraction to like what is actually happening inside the market. So Todd, you have a great chart, chart A please, fellas, talking about cyclicals versus defensives. And what we're seeing here, and Todd, I'll give you the mic in a second, this is the underpinnings of a bull market that if you're talking about continuation and expansion, this is exactly what you need to see. So Todd, what is this chart that we're looking at?
This top panel here is just your simple cyclical sectors, industrials, financials, discretionary, tech, relative to the staples, healthcare, utilities of the market. On the bottom panel is a simple 3-month rate of change, and we've had the best 3-month rate of change coming off of that April low in the last 15 years. This is what Shannon said earlier about the fundamental backdrop, right? Corporate America figuring it out in a very bullish stance. Of course, can I make the case for a September pullback? Yeah. But the fact of the matter is big momentum is risk on for this. You're in pretty good shape. This happens at every significant low, these types of surges for offenses versus defense.
we're also seeing, it's funny, the market, like as soon as we talk about narrow breadth,
Yeah.
and there is some narrow breadth, and we'll talk about in a sec, and concentration. Yesterday, Frank Capillari tweeted, the S&P 500 just logged back-to-back 80% breadth days for the first time since April. Even more telling, and it's one day, but whatever. Tech had the lowest amount of advance in stocks at 69%, and the equal weight outperformed by more than 1%. So maybe this is like the catch-up trade that happens every single time we seem to mention breadth weakening.
Yeah. I think a lot of it's coming from discretionary too, to be honest. Corners of discretionary have been off the field for a while. Durables, home builders.
Home builders back.
Now they got hit today because rates popped again. But that's been a pretty important cyclical group that's coming back on the field. Some of the autos, they've been a pain trade, starting to come back. Retail's all right. Now the restaurants are taking a hit, but like discretionary's working. Tech, semiconductors, industrials, machinery. So that's that breadth right there. It's the non-NVIDIA, Microsoft type stuff that's still pretty good. The equal S&P is a day off of a new all-time high.
All right, we'll zoom out to zoom in. Shannon, you brought a chart 11. So all-time highs are bullish.
They are.
Talk about it.
So, I think this is the challenge, is that you generally tend to see, in particular, when, the momentum factor is behind as a tailwind. And I am not a technician. I'm just going to say that right now. I listen to folks, but I think why I pointed this out is that the question I get the most is like, have I missed it? Right. And so every time we crest one of these all-time highs, what I continue to look at is, if you actually break this down, and I didn't bring this in terms of all of the different periods where we have continued to set all-time highs, what you'll find is that there is a persistence in the performance. What's the outlier here is sort of that 18-month period. And that's really what has been happening over the course of the last couple of years. So that's much higher than it was if we had drawn the same graph prior to COVID. And what you're seeing is that, in terms of this average gain after, an all-time high, what we've seen is that the concentration that we're experiencing over the last 5 years is moving this average gain higher. So if you take out this previous period where we've had some really strong performance that's been concentrated in tech, these numbers are a bit more modest in terms of the percentage gain, but the persistence is pretty similar. And so I think that's an important point, is that, we're not necessarily saying that we're going to replicate this type of performance after an all-time high. What we're saying is that it tends to be kind of a persistence in that performance after an all-time high, and you kind of are set in that bull market run. Because if you think about what happens when we get a big pullback, right? You get sort of that spike back up too. And what's happened over the course since the GFC is that those lows have been higher, and we've just continued we're cushioning the bottom now. So it's likely that this number in terms of the average gain is going to continue to grow over time, because we're not seeing the sharpness of those bottoms. We're not seeing the depth in those bottoms because of the cushioning of all of these other factors that we've talked about.
I was about to say, do we think that this is like a permanent feature of the market, which is the sharp declines and the sharp rallies? But I keep having to reminding myself that 2022 was a thing, and it wasn't that long ago. And the stock market topped on January, was it 21 or 22? 22, right?
January 3rd, 2022. Yeah,
okay, and it didn't bottom until
October.
I think October
12th.
And tech stocks bottomed on December 31st.
Yeah.
So that was a legitimate, it was a 2-year bear market, and people act like that never happened.
As much as I worry about, we'll get to it, the concentration stuff, the Mag 7 as an index went down 50% that year.
Yeah, we're just acting like it didn't happen.
It's a generational decline.
It just happened. Meta, I keep saying, it sounds like a broken record, but Meta was down 2/3, like literally.
Oh, yeah. I remember saying to some of my teammates, Meta's never going back to a new high. It's done. And that was clearly wrong.
All right, so this is not a thing that people like to hear, but a pause or a pullback is coming. And I think that pauses and pullbacks are healthy. A stock market that goes straight up is not healthy. So, Todd, you have a chart that shows the best 65-day change.
Mm-hmm.
since 1950. Is there anything special about 65 days, or that's how long ago the low was?
3 months.
Okay.
3
All
months, quarter.
So the best 3-month change. And we got this chart template. So talk us through this. What are we looking at?
So now we're a little bit past it, right? April 8th was the low, and then second, third week of July was 3 months off of that low. So we just wanted to take stock of where we were. And that percentage change, just on the index level, the S&P 500, we were up 25.8%. That's one of the best 3-month percentage changes in the history of the S&P. What does that mean, right? Every major market low has seen a surge off the low. The next 1 to 3 months, the probabilities are kind of a coin toss. You don't know. And so far, they've been a good coin toss. But it's also don't be too surprised if you get a pause or consolidation we were just talking about. The more important point was the next 6 to 12 months, similar to Shannon's chart about new all-time highs, if we get there, is that the returns and the positive hit rates skew very much in your favor. So this is price momentum. Price momentum is extremely good for the long run. Of course, things overheat in the near term. It's not a shock to see things pull back. So the recovery off the April low was great on a price level, and internally the rescues were good too.
Warren Pies did similar work. Chart 12, please, where he shows what happens when you get the daily sentiment break above 70. I think this is a proprietary indicator. I don't know if this is RSI or if it's something different. But anyway, he shows the path. And once you get that extended, extreme optimism, naturally, I mean, obviously, shouldn't shock anybody.
Yeah.
It tends to weigh in returns. And he's got one that goes a little bit further back, going back to 1980. And once we get these extreme readings, the compound annual growth rate above 60 drops to 1.1% versus 9% for buy and hold. So we are a bit extended, and if we go sideways, it should be nothing at all to worry about.
Wouldn't be a shock.
No.
Right? It's not a hero call, I think, to say the market would consolidate.
No, it's definitely not. It's definitely not. Definitely doesn't take courage to say that.
I guess like my question with whenever we say that, and I've been guilty of saying that for like 3 weeks now too. So I'm going to put myself in this camp, is like, well, so what? Like, what are you going to do about it?
Oh, no.
Like, but this is what I'm saying, is like, I actually think that is more critical. And what the August-September timeframe over the last number of years, I mean, how much do we complain about? Like, we used to be able to just take a vacation in August, and that's completely off the table now in terms of what's happening from a volatility standpoint in the market. But if you think about, what does that period mean, and how am I going to react to that August-September time period? The challenge with this year is that we've got a flurry of readings that are going to be really important from an economic perspective here in the U.S. We've got Jackson Hole. And after the last couple of press conferences, I don't know how much confidence you have in the messaging that's going to come out of Jackson Hole, but I'm a little concerned. And then we've got the Fed meeting. And then we really roll into, I think, in the fourth quarter, I think that investors are going to start to look at something like the big, beautiful bill and the deregulation that you talked about earlier. And they're like, okay, so when is this? Like, we're going to start seeing this transmit, right? And so this timing of this period of this normal seasonality that we experienced, coincident with all of this really market-moving data. I mean, we look at last summer, we obviously had the unwind of the yen carry trade, but that was sort of the push into August and some of the volatility that we experienced. I'm a little bit concerned that perhaps investors will not feel quite as constructive in investing in September. So I think we could see this as a little bit longer a period. Maybe it lasts 6 or 8 weeks where we get some squishiness in the equity market, where we feel like that sentiment is not quite there. And I just wonder how that could potentially manifest into like the fourth quarter, when we're really looking for people to be reallocating and likely increasing their allocations to some of the laggards that we talked about earlier.
So this is a good point. It's like, all right, so what? We're extended. Who cares? What's your point? So what? We should expect a short-term pullback in the next couple of weeks. Like,
and what do I do about it?
Exactly.
Like, what am I supposed to do then?
Right. All right, so here's what I would say. If you are fully invested or where you want to be, yeah, you're right. Who cares? Go live your life. Enjoy the gains. Say thank you. Market can't fall for more than a day. Even today, we had a gnarly PPI reading in the morning. Yields shot up. Stocks fell at the open. Stocks are now flat. S&P's flat. Equal weights down. Who cares? Nobody cares. But here's what I would say. If you are feeling like, if you are underinvested and you're feeling like fear, this market will not let me in. I can't believe I'm missing all those gains. If you're feeling those feelings, and how could you not if you're underinvested, then I would say, just wait. just wait. And you might have to wait a week, 2 weeks, 3 weeks, a month, 2 months. You will get a better entry. Probably, maybe. Is that fair?
I think that's fair. I mean, that's what I think. I mean, that's my view is that, we're looking down the potential for an entry point for people that feel like they've missed it.
You'll get one.
But we hear this all the time. And I think that's why, the work that Todd does is like really important to thinking about.
It's kind of you.
No, but thinking about how do we square that longer term. I'm a fun partner here to be
that's a Seth Rogen.
You should bring out Seth Rogen.
So I feel like there's an opportunity to square some of those or overcome some of those objections with mirroring it with some of the technical data, because I think that there are times when this is going to feel very uncomfortable, especially after the PPI reading. Do we get another, really lackluster non-farm payroll support? Then we start to hear about recession concerns and considerations. And that's not our camp. But I think being able to combine it with that technical work and that look, I think that that's where you can really push and catalyze that investment for people who are like, I've been waiting and I've been missing it.
My teammate with Shannon, I think Dan Clifton.
Mm-hmm.
He's one of the best policy analysts on the street. He's the best policy analyst on the street, I should say.
I've heard we should have him on the show multiple times.
You should. He's amazing. I can't speak for his work, but he's big on this kind of September to remember, because there's just a lot going on here. And there's a wild card in the White House that has a cell phone, which has access to social media.
Isn't it December? Is that a Lexus commercial?
It is a Lexus commercial, yeah.
Okay.
September
for all those people that buy cars for their spouses.
Yeah, so Dan is big on that. You get tariffs, the bills, everything. I can't speak for his work, but that's his thing right now.
All right, let's speak for your work, Todd. All right, so let's maybe something more tangible in terms of what the short term can bring. So you have a chart that shows levered long versus inverse ETFs AUM. And to me, this is one of the best charts in terms of showing where we are in terms of people's feelings. And when you're sort of like in the middle, who cares? But we are basically at all-time highs. So what are we looking at, Todd?
This is just so levered assets, they're getting big within ETFs because they're easy. They're access points for anyone, right? You don't need margin. You can just open up a brokerage account and buy 2X or 3X, whatever. Tesla, semiconductors, S&P. So we like to track the assets in these products. There's 130 some odd billion in levered long
and that's an all-time high.
Yeah. 100, probably closer to 135 billion today. And then inverse ETF assets have about 13 billion. So we take the ratio of them. That's at about 10 to 1 today. We started the year at 12 to 1. I think this is a new sentiment data point to me in the data set. Right? These products really exploded in 2020. So they're becoming more important. If you're trying to get a feel about how aggressive investors are, traders rather, I should say, this is the go-to chart. So again, sentiment not anywhere near where it was at the start of 2025. But if I'm putting together a list, this is at the top of, maybe we should worry about that.
Isn't this just to your point, is it just cheap leverage? Like, is the existence of an opportunity to have cheap leverage in an environment where leverage is more expensive? Like, is there some spurious correlation there in terms of?
I think that's spot on, right? This is access.
All right. So do you think that 10 to 1 is a ceiling, or is this going to go to 20 to 1?
I'd be shocked if it stopped here.
So
now it depends if the market all of a sudden pulls back 10%, that's going to clear. But I'd be shocked if this was the ceiling.
So we speak about this one a lot. NVDL. This is the Granite shares 2X long NVIDIA. This peaked in assets.
$5.5, $6 billion, something like that.
This peaked at $6.5 billion in November 2024. So the total AUM in this thing, and NVIDIA is sort of the poster child of this recovery, of this bull market. Not sort of, it is the poster child. Total assets are down a third. So I don't know, take that for what it's worth.
The interesting thing for me is you're seeing these issuers come out with so much smaller underlying now. So Bullish is going to have 2X, the filing's already out there. The quantum computing name, SoundHound, DraftKings.
All right, listen, this is it. We're not coming back.
They're going.
We're not coming back.
Yeah.
All right, so Jason Gepfert. On Thursday and Friday, this is last week, the NASDAQ 100 hit record highs with fewer than half its members trading above their 50-day moving average.
Mm-hmm.
Thursday's reading was the weakest in history. Chart 15, please. Friday's was the 6th weakest out of 751 days when this...
Oh, I love a good distribution.
When this happened. So in English, all-time highs, not a lot of participation. It's not new. This is nothing that we don't know. This is nothing that we haven't been speaking about for a long, long time. Maybe let's skip ahead a little bit. Chart 20, guys. So, Todd, you described this as the chart that keeps you up at night.
Oh, it's my favorite.
All right, this is
that's a lot coming from a chart guy.
I am like
it's my favorite chart.
I'm all the way in on the U.S. stock market. I'm bullish to infinity, but, and I'm not trying to be like sour, glass half full, but just we need to just take a beat and understand what the hell is happening. Todd, what are we looking at?
So listen, I'm a broken record with this charts. We've talked about it. You've shown it. And I feel bad, but I think so. The S&P 500 is our investing diet, right? You think about your diet. You have protein, carbs, whatever. That's the S&P 500. The diet of it is becoming more and more of less stocks, right? I guess that's an oxymoron. Less of more of less. Defensives have disappeared in the S&P 500. Healthcare, staples, utilities, energy, they're down to about 19% of the index. NVIDIA's 8%. It's almost larger than healthcare and industrials, two massive sectors in the American economy. And then if you add in Microsoft, which is 15%, they're almost larger than all four of those combined. So there's just this wackiness going on with the index and what you're investing every day.
So NVIDIA and Microsoft.
Yeah.
And there's a lot inside of Microsoft, right?
That's the argument that these are multiple
there's
companies.
There's Slack and there's a million other things in there. But nevertheless.
You heard that about financials too.
Okay,
I like that. That's a good one.
But nevertheless, NVIDIA and Microsoft are almost as large, not quite, but getting there, as every staple, every energy stock, every healthcare, and every utility. Shannon, what do you do with this chart?
So I think it points to the concerns about index investing in general. I'm not going to disagree with you that the index is constructed this way. And so I feel like if you're really looking at this from a perspective of like, how do I diversify my risk? How do I think about how my portfolio is built? Well, I think you need to figure out where all these defensives, where they lie, and how you can construct a portfolio getting more access to them. Because you're telling me that none of these four sectors, staples, energy, healthcare, and utilities, are going to continue to produce growing earnings and that they're not opportunities there. You look at utilities and energy alone and you think about the shift that we're seeing in terms of electrification and urbanization and a growing middle class globally. You need both of those things. Healthcare, I mean, it's been a dog. It's been such a difficult road investing in healthcare.
Were you about to say effing?
No, I wasn't. I know better than to do that. It's been such a difficult road. But I guess my challenge here is that this argument that there are these underlying exposures in these companies and that we need to be, less concerned about them because of their kind of conglomerate status. I just caution people on that because we have seen conglomerates in the past. You fill in the blank of those names. Those eventually get broken up. That value becomes dissipated. But what I view this as is like, this should be the catalyst for you to look at how do the products that these companies are making, how do those become monetized outside of the tech sector? And that is where you saw the growth, for instance, from 2001 through the financial crisis, right? You saw technology being integrated into everyday businesses, and that shift coming out of the GFC in 2010 and what we saw in terms of the growth of technology stocks, it was based on that fundamental shift where regular companies were incorporating technology to increase productivity and do their work better. The AI tailwind is much longer, but it's going to be much more pronounced in terms of its impact in this breadth trade. So that's why I argue that breadth is going to occur, because it's the broadening out of the AI trade that is one of the major tailwinds for that to occur.
So that's the optimistic take, and that's where I am, I think. I don't think investors are dumb. I don't think that the index is dumb. NVIDIA and Microsoft and all of the Mag 7 and the hyperscalers are responsible for so much of the earnings of the index. There's not a giant disconnect between the earnings, their contribution to growth, and where they are in the index. It makes sense. The optimistic take is that this AI industrial revolution is real and the productivity will advance other sectors, and you will see productivity expansion, margin expansion. Obviously, utilities are powering the data centers. And so you could see this nightmare scenario for the doomers who say that this is going to end badly, where you see a catch-up trade where the S&P 493 starts to benefit from all of the advancements in AI.
Yeah.
Can I ask Todd? I'd have a
Of
question
course.
for you. I'd love for you to describe that pain point that's going to occur, though, as the earnings growth decelerates for those top names, and you
Right.
maybe don't have the reacceleration to the same extent of the other 493.
That would be an index issue then, right?
Right.
Because you're so overloaded to those names that maybe are not meeting expectations anymore. And then the rest of the index is not going to be able to hold up the boat, right? So that would be the painful part. That's almost like a 2000 type scenario. Ideally, you don't want that to happen. I just think it's super fascinating how these names are just overtaking entire sectors. It almost feels like the market is intent on breaking the 40 Act structure. You can
In terms of the limits?
Yeah, because you already see it in sectors, right? These sector ETFs can't track the tech discretionary type stuff anymore because of the RIC rules, regulated investment company rules, and it's not going to happen for the S&P, but it's almost heading in that direction of we're going to break this thing because it's almost 100 years old.
You saw Russell getting in front of that by changing their
they have to
index
change.
construction. So I mean I think this is really where the challenge is, and I think that this concentration that we're seeing, that we experienced, admittedly, we've seen index concentration historically, but we didn't have as much money tied to index investing, and I think that's going to create this tension and this stress. And I think that's why you see the potential for like some pretty marked drawdowns, because there's so much tied to these indexes that, it's no longer an environment where you had prior to the GFC, where you had a lot of active allocation. Now it's very much index tied.
But this idea that there's going to be like some sort of hard reset where the
No,
behavior of investors.
it's a slow bleed.
But
you mean on the index for active versus passive?
Just that investors are going to start allocating differently. We've experienced several challenges. In the first quarter of this year, NVIDIA fell 37%. Again, going back to 2022, what happened? Like we did all that. So I guess the obvious bear case, like the real bear case, it's all in terms of like, will all of this spending translate into revenue and revenue that can be protected and expanded? So this chart, this looks like a SocGen chart. I'm sorry, I don't have credit for where this came from. But one of the bull cases for these tech companies is how capital light they were. The margins were so incredible. We haven't seen businesses growing at 20% with gross margins of 60%, 70%, and higher in some cases. So this chart shows that the Big Seven, it's showing CapEx as a percentage of cash flow, has, as we've known, gone straight up. So in 2015, it was 25%, and now it's almost 45%. Whereas the rest of the index, it is pretty capital intensive. Is the clock ticking? Like, at what point are investors going to ask, hey, where's the money, Lebowski?
I think we have this period where we're experiencing, just like, in Silicon Valley, where you want to stay pre-revenue. You don't actually want to have to start reporting how much money that you're making on these investments, because right now you're still investing for the future. You're still investing for growth. And so I think the longer that these companies who've spent this much money are able to push out that they're continuing to just build the foundation for growth, and they're not being pressed by investors who, we've talked about the rationale by why those stocks get bought when they do. If they're not being pressed by their shareholders to articulate fully how this is being monetized, I think this can go on for a longer period of time, because I don't think investors are asking those questions. I think they are still in this. As soon as they start reporting, however, that this is translating. You've seen that in firms like Oracle, right? In terms of, how is our AI spending being incorporated into sales, and are we getting that land and expand approach, and we're getting more revenue dollars per customer? The hyperscalers don't have to answer those questions right now.
Yeah,
the companies that are using
Right.
AI are having to answer those questions.
I still use it to make cartoons. So.
So the largest AI firms are now spending 1.3 times earnings on CapEx. That is a lot. And at some point, they're going to have to answer for this. And you're right. The longer the street gives them the benefit of the doubt, you don't want to disappoint. So then it's a long way down.
That to me would be the catalyst for something to go wrong when they just stop meeting expectations and the costs don't make the ends meet. Right.
There have been questions, though. I mean, Meta's seen some periods where there's been questioning on their spending and, how that was going to translate to their particular business model. I think the other thing with this is that I just recall those periods where these same companies were under a significant amount of investor scrutiny for not doing enough with their capital, for sitting with cash on the balance sheet for extended periods of time before they paid dividends, when they weren't reinvesting, when they were talking about doing everything internally from an accelerator perspective. So I don't disagree with you, but I think that there's also the opposite, which is they're just sitting with this cash on the balance sheet. And I don't think that was tenable for investors either.
Is this yours?
Yeah, this is mine.
Yeah. So this is the point that you're just making.
Yeah. I mean, I think, when you go back into the 2010s and they were just taking out, big tech was taking out low interest rate debt and they were doing buybacks. I mean, there was a lot of questions about why they weren't investing, why they weren't putting that money to work. And this is AI CapEx proxy. So, I mean, obviously we weren't talking about AI in the 1990s, but if you think about the companies that are investing in AI now, shows you kind of the growth rate of that spend. And you could argue that the 1990s, you saw tech companies really benefit from that CapEx coming into the dot-com bubble. That went way down in the 2000s, but it was picked up by the rest of the market. So maybe, again, we're setting ourselves up for the spend has been done in the 2020s by these large tech companies, and then the translation of value of that sort of happens in the following decade, which I think is what our thesis is and why the broadening out trade has longer legs.
So the boom and the bust, the boom in the 90s, the bust in the 2000s, and then 2010 sluggish spending, and now here we're all the way back. Remember, it was... I guess in 2013, 2014, it was all just like financial engineering talk. These companies just weren't spending, weren't reinvesting. I guess there was still a lot of PTSD from the crisis, but
I think that continued for tech and well into 2014 and 15. I mean, there was a very high bar in terms of tech company spending on innovation. And what was really happening then? You think about what was doing well during those periods, it was a lot of the consumer, right? It was ad spend, it was iPhones, so it was consumer related, which frankly probably doesn't require the same amount of spend as the innovation that we're trying to put into place today.
Here's something. USCF filing.
Oil plus Bitcoin. Yep. That made me, okay.
There's like a backstory at a whole wheel of cheese. I mean, what in the world? So, all right, just to reiterate, there's an ETF out there that is launching. And why not? Launch it. Who cares?
Yeah.
100% exposure to crude oil and 100% exposure to Bitcoin. But who said, hey, wait a minute, you know what I really need? This.
This is the point. This is where energy is at. I'm going to put the bottom in energy here. Like, it's irrelevant, right? No,
pound the table on that, Todd. I want to hear it. I agree with that.
I can make a case for energy, but like it's opportunity cost. So this is where we're at. We're just saying, all right, let's do oil and Bitcoin.
Plus Bitcoin.
Yeah. Like that, I don't know. Maybe that's the bottom.
I think this is a geopolitical doomsday trade. Like,
what do you mean?
Like Middle East, Russia, Ukraine, just concerned, Bitcoin store of value plus oil prices are going to shoot through the roof because of I view this as like, I could see clients who are like, this world's going to hell in a handbasket. I can say hell, right? That's allowed.
Well, you're right. If that's your outlook.
That's sort of what I think this is. I actually think that feels, and I don't disagree with you on the energy thing, but this to me feels like somebody was like, we've got the bunker people. This is for them.
This plus NVDL.
Here's another one from Balchunas where he gives you a hat tip, Todd. ARK.
Oh yeah. You want me to do the tweet? Do you want me to recite the tweet?
Yeah. What's the tweet?
Well, so I love pestering Eric. He's one of the best. ARK the other week took in about $800 million in a day, and we were all like, "Huh, that's interesting." But then it turned out to be a tax rebalance. The money came out the following days. Right. This is what you can do in ETFs. You bring money in, money goes out. It's a heartbeat trade. It's all for tax purposes. You don't generate capital gains. The last couple of days, they've really taken in a lot of money. And Eric and I are both like, this feels like they're rebalancing again. They're doing a bigger creation unit, and it's just going to come out in a redemption unit the following days. Because think about ARK. It's on a huge run. Outside of Tesla, a lot of the stocks in there have massive gains. Roku, Roblox, or maybe not Roku, Roblox, Coinbase, Palantir, Robinhood. They got in on Circle. So I think what's happening is there's money that's going in, but this is going to come right back out because of tax purposes. So it's not sentiment. I think this is more them using the ETF wrapper to avoid capital gains.
You know what happens all the time? You think about like stocks that have just had a monster run, and we talk about them on the way up, and then when they fizzle out, it's like, who cares? Yeah. So I just checked Circle, for example. Circle is down another 8% today.
It's doing the circle of life.
That's right, Todd. It was a high of $299. It's now at $140.
Yeah.
Cut in half very quickly. Remember Figma a couple of weeks ago? And they're like, these bankers got the IPO wrong, and they're ripping off their clients to enrich their other clients, which never made any sense to me. It popped to $143. It is now at a pre-IPO low of $76. So maybe whoever the bankers were actually got them as much money as they possibly could have.
Did you know Roblox is bigger than Apollo in market cap? Do your kids play Roblox?
Not yet.
Yeah.
Yours?
Never.
Ross. No, good for you.
I held firm on that. So
good for you.
It probably saved me a lot of money.
Yeah.
Based on how successful Roblox is.
just relating it back to the ARK stuff. Like it's a big holding in Circle and whatnot.
But can we talk about, but do you think that's IPO specific? What's your, I could give you my take, but I would love you guys' take on, there's been this excitement around, we're seeing IPOs again and they're coming off and they're successful. And then, we're losing part of that narrative. Like, do you think that the most recent IPOs have been successful enough to create this reacceleration of public market listing, or do you think that it's still, we're still further away from that?
I think there's been a backlog. There has been an absolute backlog for the past couple of years. The window was jam tight, and anybody that's been waiting to go, now is the time.
And they've been waiting for a while, these ones. And I don't know if all investors realize that these companies that have gone public more recently have been waiting for a while.
Years
to do it.
It's not just IPOs. It's M&A. You brought some stuff. There's a lot of M&A activity going on as well.
There is. And there's probably more discussion of M&A than we're actually seeing, closed deals, at least in the last couple of months. But if you look at, for instance, like Goldman Sachs announced that they weren't going to do their second round of layoffs because activity has picked up from an iBanking perspective. So, you're seeing this tick, and this is M&A announced transactions. So obviously not closures yet, but I think it's an important graph. The challenge is that I think we're in an environment where some of this is going to be impacted by rates as well. So I think some of this tick up is also in anticipation of a lower interest rate environment. So I feel like a lot of these cross currents that you started the show talking about, this one could be impacted. Although I do think a lot of the M&A at this point is going to be large companies with, plenty of, capital market access and cash stores to be able to do these acquisitions. I think that's going to pick up faster than some of the smaller companies.
I hear you talking about M&A. We're talking about IPOs, and if I'm looking to diversify away from big tech, just financials makes sense. Makes sense to me.
They're working.
Capital market names up and down the cap scale have been great.
NASDAQ, ICE, which I own.
Oh, the exchanges too.
Yeah.
The exchanges are interesting because they're data and they're getting into crypto. So that's another part of that segment. So if the financials are acting well, then the economy should be in pretty good shape too. Big picture.
Does
Shannon's giving me a look here.
No, I'm not giving you a look. I'll go ahead.
No, you.
No, you go.
All right. How much does the labor market matter to investors today? Like there seems to be like a minute a couple of weeks ago where claims were picking up and then sort of people stopped caring because they stopped going up, which is a good thing. Can the stock market survive what is a slowing, albeit whatever, economy? Like the economy is pretty fine, man, right now. It's not great.
I actually think that this is sort of just like what I've been trying to grapple with as I'm looking at payroll data. I think July was so bad, and it was such a huge revision that I think investors are kind of taking a step back and saying, and really saying, okay, this is probably not, like, these are probably not the final numbers. Like there's just so much noise in these numbers that I'm not going to base my decision making from an investment perspective on this particular print, because I'm going to need to see more data, because this is so counter to the data that we had already received. I don't think it's about data accuracy or there was manipulation of that data. I think it just comes down to the data that we're getting is based on smaller sample sizes. It's extrapolated out. It's just not as quality data on a month basis that we used to have. In terms of consumers, however, one of the things that we continue to look at is we look at the cohort between 16 and 25, and that unemployment rate is almost at double digits at this point. And so you can ask me what I think if investors are concerned about the labor market, I think that companies that have more exposure to a younger demographic, I think should be more concerned, because that's where we're really seeing the impact of a slowing labor market is in, sort of pre-30-year-old hiring.
Well, you saw a lot of the fast food restaurants or the quick service restaurants get killed this week. Cava, Sweet Green. So the market is working. Like the companies that are missing, Trade Desk is being disrupted in a serious way by Amazon and others. The companies that are under pressure, where their business model is under pressure, are getting annihilated. So it's not like everything's going up. It's the opposite is true.
Except for Cheesecake Factory.
Well, Bespoke had a great chart earlier in the week showing that for whatever reason, like dine-in restaurants, even like the Cheesecakes of the world versus the quick service. And I think that has a lot to do with people coming into the office or lack thereof.
I think that there's some really interesting demographic trends that are, and I think quick service is a great example. I think some travel will be disrupted based on kind of lower, younger cohorts, not being able to find jobs. I think that the type of retail from an apparel perspective, I think that certain stores will do better than others based on that, target. Is it I would be a little bit concerned about fast fashion.
What's fast fashion? Like Lulu?
No, like
the
H&M,
Dan Ives,
H&M.
line?
No. Like very, very, seasonal kind of churn and burn, low cost pieces that you buy from a seasonal wardrobe perspective, and then you don't care about the quality because you're not going to wear them again next season.
Party City.
So
or the Halloween, whatever those Halloween stores are.
No, I mean I think, but I do think that that's where the labor market concerns are likely. The other thing, though, and I would be interested to hear your view on this, is that if I look at the labor market, and we've looked at this, I think that what investors are looking at is they're anticipating that they're attributing this weakness in the labor market to AI, that people aren't hiring because they're substituting those jobs for AI. I actually don't know that that's probably the cause of this, but I can see where that attribution would come. And I think it speaks to some of the things we talked about earlier in terms of like the tail of AI, because if you think companies are changing their hiring practices because they're becoming so efficient at implementing AI, why wouldn't you continue to invest in that? But I think that's probably not the rationale around younger hiring not happening. I think there's probably some other factors, just like businesses being more conservative and discerning in this environment.
I think conservative is the right word. It's a politically volatile environment, right? There's all sorts of stuff going on. And I guess there's some fringe AI use cases, right? You can get a robot to make your salad at Sweet Green. So maybe that's also part of it, just looking way out in the future. But I go back to the political volatility. I think it's just too much for certain companies to handle. And they're just going to say, let's just dial it back for a few years. I
think companies are using AI as cover to slow down their hiring. And I also think that it's real. I do buy it. I got a heartbreaking email earlier this week from a 25-year-old financial professional who is sitting for the second level of his CFA. He has a 1-year-old and he got laid off. He's an analyst. And he said it was 100% because of AI. And the employers didn't say explicitly that, but they said, with the tools that we have today, blah, blah, blah. I really don't, I hate being alarmist, but I do worry about the entry-level roles, because entry-level jobs are grunt work. And grunt work is the first thing that's being replaced by a lot of these tools.
And there's already challenges, whether it's student loans or the cost of housing in terms of household formation of those individuals. And so we're exacerbating that problem potentially by having a bunch of people come into the workforce that were geared for these types of jobs. These types of jobs aren't there. That doesn't fix itself in 2 to 3 years. People don't go to trade school, all of a sudden. It's going to take 5 to 10 years and for a shift in some of these other trends that we're talking about, such as manufacturing, reshoring, or automation. That's going to change. That doesn't happen overnight.
But isn't a lot of the work that you do being outsourced now to AI stuff?
Me, no. I don't think it takes a human to look at ETFs and what the heck is going on in them.
Oh, you? Anything?
I think that's funny because I think all of us
you can't be replaced. Tom.
I think that I can though. Thanks a lot. I think some of the things that I would take up less time for me because I'm utilizing AI. But I think everybody is going to sit here and say my job can't be disrupted by AI. I really feel like we should all. I agree with you on that point that we need to be introspective about what do we do that provides value that cannot be replaced. I think that is a conversation both individuals need to have with themselves, but also companies are going to have over time to think about how do we, because companies would also argue that they're looking to incorporate AI in order to maximize the value-added pieces of people's jobs. It's hard to add value when you're 22 years old and you don't know anything about the industry you're entering.
Mm-hmm.
Yeah. Shannon, you have a chart showing U.S. employment. This is a big part of the story. Foreign versus native workers. And I have to ask, what are these charts? Where do you make these charts? What are we looking at here? I've never seen this before. They're like yellow. Are these? Is this Excel? What is this?
No, this is our branding. So okay. I make them at MB Private Wealth. We make them, I should say. It's not me. So it's our team.
What's the story here?
So one of the long-term things that we're watching is this shift in immigration and how it could potentially be inflationary over time. There was a lot about this in November, December, January, that there was going to be this big shift in immigration policy. And then tariffs hit and everyone's like, oh yeah, immigration on the back burner, even though we continue to see obviously pretty meaningful shifts in immigration. I look at this primarily from an inflation standpoint longer term, in terms of foreign-born workers decreasing as a percentage of the population, native-born workers increasing, and the potential wage impact on that. I mean, we've heard from industries, we hear from farmers, we hear it specifically. I mean, I don't know if you saw some of the news coming out of like Nebraska, for instance.
Oh, sorry.
So I think that one of the things that we need to think about is that if services inflation is truly what the Fed is most concerned about, and you think about areas like medical care services, which was hotter in the CPI report that we just received, there's a lot of foreign-born workers in that, and ostensibly they have accepted lower wages over the course of the last number of years, particularly in the last, as you see this chart here, 7-8 years where this has really increased in terms of those workers. I look at this as an inflation issue and a labor supply issue, and we're continuing to see that. So I think this is something where, again, going back to specific industries, going back to specific sectors, companies, how many entry-level employees did they employ? How much of this could potentially be disrupted by AI, which, could offset some of this decline. But I think this is important when you think about, are we in a higher inflationary environment going forward? And I think that this is part of it because wage inflation is likely to continue to persist if we're hiring more and more native-born workers.
So since Trump presidency, foreign-born workers shrank by 3%. And of course, they're cheaper labor. Native-born workers grew by 2%. So yeah, maybe some pressure on prices.
That's a pretty short time period to see that type of decline.
Yeah. What was the Nebraska story that you referenced?
Oh, the inability to have enough workers to harvest, and the fact that it's impacting state revenue collection because volumes are down. So, and the Nebraska governor, I think, came out saying that it was because there's the shortage of workers from a farm perspective.
Okay, Todd, you have anything to add on Nebraska?
Well, our guest, Sam.
Nobody cares about Nebraska. It was just an example.
My teammate who's joining us in the room here, Samantha, she covers Nebraska, so she's got firsthand boots on the ground type experience here.
All right.
And I'm not wrong, right? No?
Todd and Shannon, thank you for hanging with us today. Before we get out of here, the new thing that we do is what are you most looking forward to? Shannon, what's up? What do you got going on?
For the rest of the day?
Or life.
Or just
anything. What's up? What are you looking forward to?
Leaving here.
All right, Todd, what are you looking forward to?
I'm going on a family trip next week.
Where are you going?
Utah and Colorado.
Oh, hell yeah.
The wife, my 2 boys, then Future Proof,
That's right.
and then the new Tron movie. Oh,
You're into that stuff?
I love that.
Jared Leto's in it?
Well, yeah, that part I don't know, but Jeff Bridges.
Jeff Bridges is
come on.
back.
Yeah,
Yeah.
it's Tron.
And are you excited for Blues Traveler opening for Bush?
I will have left by then. Sorry.
Where are you going?
I got to go back to Vancouver. I'm not joking. I would be in Vancouver twice in a month.
Unbelievable. Leaving.
Yeah.
Okay.
A Canuck.
All right. Shannon, what are you looking forward to?
I'm excited to, as I always do, eat at Land Ho in Orleans on Labor Day weekend.
Why do you always do that?
It's just it's a thing we do. That's
Okay.
what we do. We spend our weekend down there. And my son starts high school in a couple of weeks, so I'm really excited for him and him taking on that new challenge. And I'm going to try to figure out what he should be studying so that when he graduates, he can enter into this increasingly difficult job
Is
market.
he athletic?
He is athletic.
Maybe that's it.
He plays golf and baseball.
Yeah, I can't replace athletes.
Not yet.
So,
Yeah.
All right. This was fun. Thank you so much. Listeners, thank you for listening. Josh will be back with us next week. We have a very special guest next week. It's not Dan Ives, but it's, let's say it's Dan Ives adjacent. Thank you for listening. We'll see you next time.